Welcome to Advice from the Deal Room. Today, we are talking about commercial loans and the various different types. Commercial lending isn't just a product, it's a toolbox. Today, we're mapping out the toolbox so you know what to ask for, what to avoid, and how to pick the right loan for the deal. Matt, take it away.
Yes. So a lot of the times we get asked about, oh, what kind of program does this fit in? What your programs look like? And my always word is, what are you trying to do today? What are you trying to do tomorrow? What's the best fit for you today and in the long term? And there are a lot of different loan types out there. Loan types is a better way to put it than loan programs. So that's kind of how we view it, is loan types and what structure do we want to put behind that loan type. So compared to the residential world, which is a lot of people have that experience before they ever get into commercial, they understand, okay, so this is a 30-year mortgage, 30-year fixed rate, DTI, yada, 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 right? They understand that. But when we go to commercial, they're like, oh, well, my DTI is good and my credit score, I'm like, yeah, cool. Yeah, we care about your credit a little bit. DTI, we calculate things different, as we've talked about in previous discussions. But where does that fit in the loan type? How do we structure a deal? Those are the more important things. And there's a lot of different loan types out there. First of all, it's just the normal loan type, which is commercial, conventional financing, right? It's you're getting from a bank, credit union, typical financing out there. Then we had the government-backed programs. We have SBA, USDA loans. Then there's the agency loans when it comes to multifamily and other projects around those type of projects, so senior housing, skilled nursing. We have Fannie, Freddie, and HUD. Then we also now have the other loan types out there, alternative lenders, bridge lenders. They're the in-between conventional financing to hard money lenders. We have those avenues as well. Those loan types are out there, and it's all circumstantial based, from alternative lenders up to the hard money lenders. Another loan type we have is CMBS, the commercial mortgage-backed securities. Those are typically lower leverage, different, interest-only products, non-recourse, depends on the borrower, and those are usually larger loan amounts. So those are the different type of loan types. We also have non-real estate loan types like operating lines of credit, inventory loans, AR, accounts receivable, backed loans, things like that to help in operation needs of a company.
You mentioned one thing real quick there, and I want to make sure that we clarify recourse versus non-recourse. What's the difference there, and what loan kind of types fit into each?
Recourse is you're personally guaranteeing a loan. You're personally liable back for it. Non-recourse is there is no personal liability back besides typically bad boy carve-outs. Any falsification, any fraud that went on, then it can come back to you personally. Typically, most loans are recourse when you go to banks, SBA financing, but when you get into the agency financing and you get into CMBS, those are non-recourse. And there's some private money lending out there that are non-recourse as well. The advantages of those is depending on what the needs of the client is, depending, if it's an investment, the investment structure behind the scenes, what kind of liability are they trying to protect themselves? Typically, your higher quality assets have more non-recourse options than your lower desired asset classes. That's multifamily is typically your number one for non-recourse lending.
Generally, they're lower loan to value, isn't it? Generally,
Correct.
like 70% or less is kind of
Correct.
what we're seeing on those.
65 is typically the norm. We can push up to 70, but it's typically where you're maxing out on those programs. When you go to agency, you can go up to 80% with agency. So those financing options are available, but that's a slightly different product than the CMBS non-recourse. But some banks and credit unions do offer non-recourse, but again, it's a lower loan to value. And the non-recourse thing is really how the lender can access that asset. So non-recourse loans are typically a single asset entity, special purpose vehicle that only owns that asset. Because what happens when you default, the lender then takes over that LLC that owns the real estate. That's how they acquire their collateral in this deal.
Makes sense. And generally, we're seeing those at like minimum loan amounts of like $1 million or more, right? To qualify for any of those programs. You're not really getting non-recourse for less than $1 million.
And usually you want to be higher than that because some of the legal costs associated with non-recourse, some of the attorney fees that come into reviewing documents, and they're just a little bit more cost associating that with, especially getting in that single asset entity, the way the lender needs to see that. So there's a little bit more lender costs that are associated with that you want to have a larger loan amount to be able to spread that out over a large, spread out a fixed cost over a larger loan amount.
So let's go into the government-backed ones, because I feel like those are the ones people probably hear about a lot. The SBA loans, the government-backed loans, but they don't really understand what they're for, why they're not necessarily always the right move, and sometimes they're like the only move that you can really do.
Yeah, so we have SBA. We'll start with SBA. That's a very throwing out one out there. It's for small businesses, right? They're there to help your small businesses own their own real estate, buy a business, sometimes working capital, whatever their needs might be. But typically, that's where SBA comes in. You have a 7A product and you have a 504 product. Two different reasons why you'd go to them. 7A typically are floating rate. So they're usually prime based. So prime plus a spread. There are a few lenders that do price more aggressively. And the reason that they're prime plus a spread is majority of lenders take those loans and sell them on the Wall Street. So they get a higher return for the spread against prime compared to a fixed rate product. So they're selling on the Wall Street. So 7A, typically that it's really good for business acquisitions. 504 is not for business acquisitions. 504 is for equipment and real estate only. Nice thing about the 504 compared to 7A, there's multiple factors. Is first of all, in the 7A product, so the way that SBA views real estate is they say it's worth $1 million. They'll go up to 90%, correct, on an SBA deal. So you only have to put 10% down. However, SBA always goes to 85%. If you go to $1 million value on the instance I just said, you're down to $850,000 worth of collateral. So they have a collateral shortfall because they're loaning out $900,000. Easy math, there's more fees than that. But you have a $50,000 shortfall at that point. They have to get additional collateral to make up for that shortfall. So typically SBA and the 7A will put a lien against your primary residence or other real estate you may own. They have to take all additional collateral and make themselves 100% collateralized on a deal. If they can't become 100% collateralized, there's always an assignment of life insurance that can make up a shortfall in any deal that's not be able to be 100% collateralized. Where the 504 is where the bank makes a loan for up to 50% of the purchase price, and SBA makes a loan for up to 40% of the purchase price. But SBA is in second position, and they do not require additional collateral as compared to the 7A. And the 504 also has a fixed rate. It's a 25-year fixed rate. Those rates print once a month. They're debentures, they're bonds that are sold onto Wall Street. So you will have two loans once it's all said and done with an SBA 504. You'll have your bank loan and you'll have your SBA loan. So the only disadvantage of the 504, it does take a little bit longer. So you have to work through a conduit, a CDC, Community Development Corporation, to be able to access the SBA on that. The CDC works in parallel along with the bank, but they typically need the bank's approval first before then they can get their final approval, submit to SBA, which SBA is backed up at times.
Yeah, with the government shutdowns, the last few months have been rough on the backlog.
So when the government shuts down, they shut down SBA typically, which requires SBA approval on a 504, where at SBA 7A, the bank, their preferred lenders, make the final approval decision. The only thing that the bank is looking for on a 7A from the SBA is a guarantee number. So eligibility requirements, everything like that, to make sure they get their guarantee number from SBA. Where 504, it actually has the SBA office approve it. So SBA is a very good tool, but it's thrown around because a lot of people, I don't want to go SBA. It's a pain to go through. It's a very complicated process. They hear horror stories. People don't like to lien on their house. Many different reasons why people don't want to go to SBA. Plus, it's a longer process typically than a conventional loan. Our rebuttal to that is first, we try to take all the pain out of it here at AEI because the paperwork is gruesome, but we understand how to get through that paperwork and how to effectively navigate through the seeds and get everything that the SBA needs on a deal. Second, when they're talking about putting a lien on your house, what I always tell clients, you're personally guaranteeing. If this was a conventional loan, you're going to be personally guaranteeing it. So personal guarantee is like having a lien on your house without having the actual lien. The difference is SBA is upfront about it. They put the lien before you default. And if you default with a conventional loan and you're personally guaranteeing it, the lender is going to put a lien against your primary residence to protect their interests. So at the end of the day, you're in no different position than you were SBA from conventional based on collateral, based on your risk. You're personally guaranteeing both deals. SBA does have caps on how much you can borrow from SBA at one time, have loans outstanding. Those $5 million typically right now, you also have, it's where the 7As, you're up capped at five, it's set at $5 million, the 504. The nice thing about splitting a 504 is that bank loan that's 50% of the purchase price does not count towards it. It is only the guarantee portion over here, the SBA portion over here. So you do have a little bit more runway there by splitting things into 504. Then 504's got a 504 green program where you're allowed to do up to $5.5 million per instance, and you're allowed to do it 3 times. So you have a lot of capacity, and the green capacity is you've got to make the building green. This energy savings back to the building. There's ways to document that, and we've done those loans as well. There is just different ways you got to go through the process, and it's additional cost, but it's worth it if you're at your capacity. We see a lot of SBA deals when it's gas stations, hotels, because they're the undesirable projection-based deals because they're buying something that's underperforming, and they're going to, this is an expansion of their current business model. They're going to make the financials look better through projections to their own, taking over mismanagement from the sellers. So SBA is great in that essence. Business acquisitions, a great tool for business acquisitions. SBA is a good product. It's the time and the place for certain people, for sure.
The big thing I want to make sure we call out there too, and why gas stations and hotels work so well for SBA as well, because you'd hear, small business, that means most small businesses should be able to do it. You have to, if you're using it for any type of real estate, you have to occupy over 50% of the real estate. So for hotels and gas stations, they're 100% owners of their spaces. When you have other businesses, you kind of have to either have a big enough space that you're occupying all of it, or set up in a way that maybe you can have 2 or 3 tenants that are taking less than 50 and you can get the other 50. But most of the time, you're seeing single building, single business done through SBA.
Correct. So SBA is a good product, especially on the projection-based deals, trying to get higher leverage too, because you can get 10% down. There's certain asset classes that they have 15 and 20% down requirement, but that does provide an advantage back to people to grow their portfolios, especially when you're speaking about gas stations and hotels. Typically, gas stations and hotels are limited to 70% conventional financing. So you're bringing less money down. You're having more leverage with SBA. They take projection-based deals. It's a pain to get one at times, but there's a lot of lenders out there that are non-bank lenders that offer SBA as well. So there's a lot more avenues to get an SBA deal completed than just walking into your local bank.
Mm-hmm.
And the misconception is, it's an SBA, it's a government loan. They're all viewed the same. No, it's not. The banks still have risks. They get a guarantee from the government, but not for the full loan amount. They're not 100% guarantee. So the banks still have a risk in every single deal that they lend out on the SBA world. So everybody's got a different credit box. It's like speaking to an attorney. When you look at the SOP, you're going to get 5 different answers. When you speak to an attorney about anything, when you speak to lenders, you'll get 5 different answers to how they view the SOP, which is standard operating procedures of SBA, and how they look at things. And then also their credit boxes are different. So it's not one size fits all for SBA from an SBA lender perspective. And I think that's a big misconception out in the marketplace is SBA, it's the same if I go to this place or this place. No, SBA is completely different depending on where you go.
Well, and depending, like you said, on their appetite. I mean, some lenders may want it for a while. They may love hotels. They may have appetite for SBA programs for hotels in their book. And then they get filled up and now they don't want to touch them anymore. And so they slowly start pushing out the deals they have. They find other lenders to take them on. And that's where it's not necessarily the lender. It's where, how do we place it with it based on where their appetite is, based on the deal, all of that type of stuff.
Correct.
Let's go into conventional. I mean, everyone kind of knows basically what conventional is, but when are these used and why are these used?
We missed one USDA
Oh,
for a quick second.
oh, yep, USDA. Sorry, those are boring, but
USDA is for real estate backed businesses. So you're buying hotels, gas stations. It's not for business acquisitions. It's their USDA BNI program, and it is good for rural locations. So if you have somebody that has SBA, they're maxed out in their SBA, and they're doing something in a rural location, it is great for them to use USDA product. It keeps their flexibility up. And we've done gas stations to the SBA, multiple gas stations to the SBA in rural locations. And it's based on the size of the population around within a few mile radius around that current location. So it depends on the location. There's a mapping tool that is out there on the internet that we use to map out to make sure that that does fit the USDA geographical demographical uses. So it is a good product to have out there in the tool chest for people depending on what their needs are.
yeah, those are also used a lot for just like ag loans and stuff too, aren't they?
Yeah, so it's a good program out there. I do like it. We're doing a few more of them lately because of SBA capacity of borrowers, and they are located in rural-ish locations. So it is a good product for them. It is a little bit longer process than the SBA process because you have to get the bank approval, and then they have to go, depending on the loan size, under $10 million, the regional approval gets the deal done. Over $10 million, they get the regional approval and they get a national approval. So it's a much longer process and they're a little bit more antiquated in how they do business at USD versus SBA. They're definitely a little old school in their thought process, but it is a very good tool to have for borrowers that are in rural locations.
And just in general, for all commercial loans or most commercial loans, the closing process is always going to be a little longer. I feel like the SBA, USDA government backed ones are always on the longer side of that range. And you could say maybe alternative would be like the shortest tied with hard
Correct.
money. But most of the time it's going to be a longer process, and as buyers are looking for properties, as they're looking for deals, they need to keep that in mind for how they plan that purchase timeline, because it's not even necessarily that the deal can't get done, it's just that the time it takes to get it done is longer. And we
Correct.
we can push all the way we want, but at the certain time if you don't have the sellers understanding that, you can end up losing your deal down the road, and it could be out of no fault other than just that's how the cookie crumbled that time. So,
Timing is everything in each one of these deal types. Everything is important. Having your realtor understand the different products that you're planning on using so they can understand the timeframes is very key. I have calls. I just had a call earlier today from a real estate broker that was like, "Hey, we're going to hit this deadline." They asked me the deadlines they need up front before they put it in the purchase and sales agreement. Because I'm like, we're going SBA, we're doing this. I'm like, I need this many amount of days to get this completed. So they at least understand this side of what's going on out there in the lending world to make sure they don't pigeonhole their client into a deal that they know they can't close in that amount of time. So each loan type has its nuances from a closing. And the last thing I'll vent about closing is thank God for bank holidays, guys. Bank holidays always ruins it. People always go, "What are you talking about?" I go, if you don't check the calendar, you're going to lose a day here, a day there. And usually a bank holiday means a banker or two are going to take an extra day around that to get an extra long weekend around that. So you had to be cognitive of taking into consideration the time frames and the banking holidays. Unfortunately.
we as
So,
brokers always get asked, well, are you guys working today? And we're like, well, we're working with our clients, but no bankers are answering our phone calls. So we do our best,
yeah,
but
nobody's
um,
calling me today. So
no
yeah.
one's getting back to us. We'll
Yeah, let's
tie
get on
more
to
into
that.
that timing thing as why that is important for different deals and why you might use a different deal type as we kind of go through all of them. But conventional and credit union
Yes.
loans.
Those are construction deals, buying real estate, refinancing real estate. That's when you also get into your operating lines of credit, working capital. That's where your banks and credit unions, we work with a decent amount of credit unions because typically they have a little bit better rates, a little better fee structure typically. They're easier to work with sometimes. Sometimes I will say sometimes they're a little bit more difficult at times when you get a very complex client because they don't have the same structure back office that some banks do. But a lot of credit unions over the last few years have continued to ramp up their commercial lending. So that is one avenue that we continue to use. But we look at all sources out there, banks, credit unions, they're all good for the permanent debt solutions of things, getting that purchase financing, refinance, construction, whatever it may be, to accomplish your goals. So that's your typical bread and butter, typical loans, but they all have their nuances again.
And we're seeing probably like max on most of these, unless it's like a really well cash flowing multifamily property, 75% or less, right? We're not seeing
75
super
for
high loan values.
no, 75 for your investor properties, 80% for multifamily. However, depending on where you're in the rate cycle versus the NOI cycle and sellers and buyers, where you're at in the pricing of deals, we go back to 2020, 2021, you could throw every deal at the wall because incomes were good for properties, expenses were kind of lower before insurance started going sky high, property taxes started going sky high,
and rates were low.
And rates were low and values were lower. So when values started moving up and rates started moving up, that started making deals had to bring more down. So typically people, what could I put down on that? I had one yesterday. What could you put down? And I go, I ran the numbers. You're going to have to put down about 40 some percent. I think they're a little shocked, but I ran the numbers and I go, that sales price is too high compared to where interest rates are. When the cap rate is lower than interest rates, that makes it very hard to get a deal done with much leverage. So that is one misnomer. I always go, so that's conventional. We can put, 25% down. Well, what's a cash flow? That's the biggest misconception also about lending is they're going into their head about residential lending. Well, I could buy that 20% down, right? Without having to go in the PMI. Actually, it doesn't cash flow for 20%. Wow. I go, the lender, this is an investment. This is supposed to be return on investment. You're supposed to make a return on your money. And we spoke about earlier, a couple episodes ago with our underwriter, and he was talking about debt service coverage ratio. We have to hit a debt service coverage ratio. It needs to make you money to be able to make the acquisition, make the lender be happy in the deal. They don't want to loan out money to you where you're losing money on that investment property every month. It's not it doesn't make the lender feel good that you're not going to just walk away from the property. So conventional financing is great. I mean, we use it the majority of the time, but it's something that people have to get away from the loan to value in today's marketplace and understand debt service coverage ratio. I'm sure the pendulum will swing back the other way one of these years, and we'll be back to everything just cash flows at 75, 80% LTV. But in today's marketplace, it's not the case.
No, especially not with where rates are at and where, rents are being kind of held down. You can't raise them as much, especially here in Washington State. Like there's a new landlord tenant law and you can't raise rents over a certain amount on an annual basis. And so you have things you're dealing with there, but rates are still going up. The cost of ownership is still going up, and you can't buy with the 20% down most of the time anymore. Or
Correct.
if you are, you probably got the deal for such a banging deal that the seller didn't know what they were getting or agreeing to sell.
The other great loan type, we mentioned it briefly from banks and credit unions, is operating lines of credit.
Yeah.
Most businesses don't get one set up, and they don't realize that they actually need one because there's a timing of cash flows. It's not that you're not making money. It's a timing of cash flow. Cash flow is king for any business. So having access to capital, even when you don't need it, is a smart move, because the moment you need that, the banks don't want to lend to you. So get the tools set up before you need it. Work on that line of credit. Use it once a year, use it, pay it off, revolve it again so they approve it again for the next year. Because typically most operating lines of credit are good for 1 year and you renew them every year. It's a good tool to have just to have that tool. You never know when that rainy day comes and you go, I need to have that tool.
Yeah.
It's a lot. It's
Some
a lot
invoices
more.
take a while to get paid or something, and now you're a couple months behind on income getting in. That's where that comes in.
Yeah, most people think line of credit are for construction companies or high inventory companies. Everybody should have a line of credit to get through the ebbs and flows of cash flow in your business cycles.
The other thing going off of lines of credit, and it falls into the conventional world, is the portfolio loans that we've done for clients that have multiple rental properties. And then instead of doing a cash out refi on them, we're doing a portfolio refi. So we portion up all the debt that they currently have and make that on a long-term payment. And then the rest of the available equity that can be cashed out is put on a line of credit. And so then they can use that to buy and stuff. So they have access to that equity, but they're not paying interest on it if they don't use it right away. It helps a lot of those people out that are like in a pinch where they need to close something quick. They can't go through the closing process. They can have that money. They can then, once they get it closed, we can go through the SBA process, refinance it, however, and you can use your existing equity to have access to more funds. So
having lines of access to capital, real estate is a illiquid asset in a sense. You have your stock portfolio. You can sell a portion of your shares tomorrow in your stock, right? You don't have to sell your whole stock portfolio to get liquidity. But to get liquidity in real estate, you need to refinance it, and it takes some time. You need to sell it, which takes some time. And then you have to worry about capital gains taxes and all that. But having that line of credit against real estate is valuable for any real estate owner, because now you have access to your equity that is in your building, but you don't have to pay for it until you need it.
So I think after kind of conventional and those type of loan types, we go into agency and like permanent options. We say permanent because these are generally where you put when you put this type of debt on a property, you're not trying to sell it or get out of it quickly. You're generally kind of putting it on the shelf and forgetting about it, letting it just make you the money. We'll talk more about that and why these are quote unquote permanent.
When you look at agencies, so as referring to agency, that's Fannie, Freddie, HUD. And the reason why they're more permanent loans is typically the prepayment structure of the loans. They're a little bit more complex to get out of. They have yield maintenance or defeasance, which means if rates go down, it's very expensive to get out of that debt. I mean, typically this is a refinance it, hold it for a while. So the prepayment penalty is very restrictive on some of those assets, especially when rates are going down and you have a 6% rate and rates go to 4%. It's going to be expensive because this is now a bond that's been sold in the Wall Street. Fannie, Freddie, HUD, CMBS, those are all Wall Street bonds. So somebody's holding that bond, expecting that yield. When rates go down, they need to replace to pay it off, they need to replace that same yield that investor was getting. So it's a very expensive debt product to get out of sometimes. It's a great debt product depending on your needs, right? Everything is need-based. It's the non-recourse. It's the
interest-only options. I mean, those are some of the crazy
options
options about those. You can treat basically like an annuity. The property's value stays the same. You have the same amount of debt forever on it because you only pay interest only, but the value of the property is going to continue to rise.
And the nice thing about an interest-only product, and people go, why would I do interest-only? I go, if interest rates are very favorable to you, let's just call it 5%. If you paying down your debt by having a principal and interest payments compared to interest only, your return on your principal payments is where the interest rate is. If you feel you can take that extra savings on a monthly basis and invest into something else that gets you a higher return than 5% or whatever your interest rate is, that's where an interest-only product comes in value. And instead of waiting until 5 to 10 years when your loan matures to then refinance it, recapitalize to your next thing, you're recapitalizing on a monthly basis. It's a great tool to have when you're not looking to recapitalize a big recapitalization in a few years because you did a big, it's going to go up in value really quickly. This is a long-term stable asset. The value will go up, but it doesn't have, like, you just didn't do a big renovation, a big increase on rents that, in 2 years, the value is going to go up 40% or something. That's not the case. It's just rising with real estate values and what you do with your rents because you're at stabilization already. It's a great product to have. You get to set it, forget it. The loan gets paid, everything has happened. You don't have to worry about it for a while. And you have, especially during the interest only, you get some of that annuities. It's more of an annuity than it is anything else, which is the ultimate goal, right? Is having cash flow and you're still building equity and you improve your cash flow because interest only does improve your cash flow because you're not paying principal down every month. It's great products. Majority used in multifamily sectors, the Fannie, Freddie, HUD. There are some senior housing products we can do, skilled nursing. So those are different mixed use products depending on the usage, the square footage, and the income that is coming from the commercial space in there. CMBS does do hotels, they do some office space, but office space, a little skeptical.
Don't begin on that right now.
So they're being industrial properties, things like that. It's great for some CMBS deals for sure. And those are not for the faint of heart. It depends on where interest rates are, where spreads are. That market moves a little bit more volatile than other markets. It's based off of spread off of treasuries. Going back to COVID era, 2020, 2021, they had very tight spreads on CMBS. The CMBS spreads have widened a little bit in the last few years. And so they're not as advantageous for somebody. Nice thing about CMBS versus an agency on a multifamily deal is when CMBS underwrites the deal to their debt service coverage requirement, they're underwriting it with interest-only payments. So if they need a 1.30 debt service is typically what we see from multifamily, they're underwriting it with the interest-only portion of the interest rate given. However, when you go to Fannie Freddie, and you might get interest only from Fannie Freddie, they still underwrite it to their debt service recovery.
Like you're going to pay it down.
Like you're going to have principal and interest payments. So from a leverage perspective, where we're at in today's environment, that can change. You can get more leverage with CMBS. So that is some advantages there on the CMBS. The nice thing about CMBS and agency deals, they're assumable loans. So if you were to sell your property, you have a very favorable rate. Somebody wants to assume your debt, they have the ability to assume the debt because this is a non-recourse debt. They're assuming the debt of that asset, of that LLC that you set up for that asset. So it does have those options like that people don't realize, those loans are assumable. So if I sell this, somebody can assume my really good rate with this if they have the down payment.
Basically, they're trying to keep you to have that debt stay with the property. That's why it's assumable. That's why they're non-recourse. They view it as that property is basically its own business entity, standalone from anybody else, and it should be making its own bills and paying its own payments, all those type of things.
Yeah. The nice thing about HUD has got a 35-year fixed rate when it comes to multifamily. The HUD product is not for the faint of heart. Again, there's a lot of different hoops to jump through, nuances to get a HUD loan. However, you have a 35-year fixed rate on it. The rates are very competitive. They're usually we'll just estimate it out there, approximately a 1% spread over treasury. The debt service coverage requirement is 1.15 on a 35-year fixed rate. But you still have to pay the insurance premium, which is 0.25. However, that is taken into consideration when you look at your debt service. So you have the ability to get higher leverage with HUD right now than you will with other products because of the 35-year fixed rates, the way that they changed the green program. So those factors are advantageous to you. But the process is lengthier to get through. There's a lot of requirements when it comes to the structure, the design, the measurements of countertop heights, door widths, everything. They got so much ADA compliance around some of those that fixes that need to go into buildings to get it to HUD requirements. So, the recommendation, if you're looking at HUD, would be to make sure you plan that out before you go to construction. Yes, there is a construction product through HUD, and it does allow up to a 40-year fixed rate. However, with HUD, there is a lot more hoops to jump through for the HUD construction product than there is just for the typical construction through a conventional lender and then taking it to HUD for stabilization. So there is a few nuances. We're not going to get into all those nuances today, but there are some other nuances on the construction product for HUD.
A lot of times you kind of end up marrying the different loan types based on the phase and process that you're in. So you might start with a certain loan type like bridge or hard money, depending if that's what you're needing for the situation, which we're going to get into those. And you then might end up at HUD once it's stabilized and once it's finished and you're ready to kind of put it away. You're not going to use only one loan type your whole time in the commercial real estate space or commercial space. You're going to end up using them all.
We typically do, depending on where things are at in the cycle, but sometimes we start with clients with an SBA loan so they can acquire a property. And then after 3 years, after now the value has gone up, they paid down some debt, we can refinance it to a conventional product. We have done different ways into accomplishing that for clients. The next loan types we're going to get into is alternative and hard money loans, bridge loans. We've had clients construct with hard money and then take it out to permanent financing or conventional financing and actually get some of their capital back to be able to go into the next deal because they were able to move fast with the hard money. They were able to do things that they weren't able to do with the conventional financing, but the conventional financing was willing to lend them up to us, higher LTV. Depends on where rates are, depends on multiple factors. That's why loan types are not one size fits all, guys. Depends on the time, the players, short-term, long-term goals. And that's where the bridge lending, alternative financing comes into play. So what do you have going on today? Where are we going to tomorrow? That's why one is called a bridge loan, right? We're going from here to here. We're trying to go from today's problem to tomorrow's solution. So, we've completed bridge loans for people who need to recapitalize their balance sheet, and conventional financing was going to allow that. So we've recapitalized them on some agricultural loans, recapitalized their balance sheet, wait a couple of years, so we're able to take them back to conventional financing, which allows them to get a better rates, better terms, but at the time they need to get from point A to point B, and this is the only way to help them accomplish those goals. I've personally used a hard money loan to purchase a building. We purchased a building that needed a lot of renovation, no tenants in place. It's really the only other way to typically do something like that is do it all in cash.
Yeah.
You have nothing in place. You have no tenants lined up. You have full remodel, regutting of the property. It's a steal in the market because of the price, because it's been sitting around for a while. So typically hard money, bridge money comes into play into those situations. It's timing, it's the stress of the property. What, could be your financial situation of the property. Your property could be underperforming, but you just want to take it from point A to point B and you need to get time to get there. That's where these loans come into play. So, sometimes people use hard money to go buy something in 1 to 2 weeks. So they kind of act like cash buyers in a sense because they can move so fast compared to somebody who has a financing contingency and it's going to take 60 days to close. Well, can I get a 5 to 10% discount, 20% discount if I close within a week? And there's no financing contingency, we just close because you got a hard money set up behind you already. So there's avenues where these come to play. Sometimes you need to use hard money, alternative money, bridge money, where we would call for construction financing too. So those play avenues depending on the circumstances.
Yeah.
We don't always recommend it. It depends on the circumstance for the client.
And one misconception that I think a lot of people, they hear hard money, they think that means like it's a bad deal or it's like got too much hair on it that most lenders wouldn't even look at it. And while that's true sometimes, it's often the timing thing, like we were talking about. It's often the buyer or the seller's in a position where they need the money now, or the buyer wants to move quickly because they can get it at a better price. They're okay with paying a little bit extra because of that opportunity. They don't want to miss out on the opportunity. They know that it's a fix and flip. So they know that if they can just get in there quick, they can get the money to fix it up. They can sell it for a lot more, and they money on the table for both sides, even after all the fees. It's not always a bad deal for hard money or bridge. It's often there's a story is kind of how I describe it. There's a situation that you're
Right.
in that you need it for this. Obviously, we would all
Yeah.
love to get the lowest rates and financing all the time, but there's times where you got to use the more expensive options.
Sometimes the cost of doing business is well worth the long-term return. Usually hard money deals have a little bit more risk associated, but there's a higher reward on the other end for people. So there is a time and place. And again, this kind of helps. Having this helps us wrap it all. Or you heard all these loan types. As you heard, a lot of them depends on the timing, your situation today, tomorrow, what's your goals, what else do you have going on in your life. So it's not one specific loan type fits all for everybody. Everybody has a different situation. That's what I love about commercial. I know we've mentioned it before, is every deal is different.
Yeah.
Every circumstance is different. Let us understand that that's where we come into play, is help us understand what's going on today and tomorrow. What's your goals? Let's help you accomplish those goals. And then we worry about the loan type afterwards. I don't come out going, here's a loan type, spitting all day one. I'm indifferent to loan type. I'm into what loan type fits your bucket today.
And helps you cross the room in the way and time that you need to. Because a lot of times clients will call us, hey, what kind of rate can you get me on something like this? And we can throw a range out to them and get bullshit. But at the end of the day, it still comes down to what's your situation? What are you actually trying to do? And then I can advise you what situation you're going to need to go towards, what loan type you're going to need to fit into for this project at this time. It's not just, oh, it's going to be 90% financing and a rate in the sixes. Like, that's so broad, and it really will all depend on, is it a hotel or is it a gas station? Is it owner occupied or is it not? Is it cash flowing? Is it
Right.
need work?
How strong are you financially? How long are you willing to wait? Because there are some, as was mentioned, there's some fixed rate SBA lenders out there, but those lenders they take a little bit more work to get to. They're a little bit more conservative. Their underwriting process is a little slower than you would get your prime plus 2% spread, whatever it may be. There is time and a place for everybody's circumstance. So understanding that helps us also navigate where to take that loan to, what lender to take that loan type to, right? Depending on what you're trying to do, and be realistic and go, yeah, you might not qualify for that fixed rate SBA loan. You might have to go do this based on the circumstance. As long as it still makes financial sense, then you move forward with the deal, right? Again, that's where we come with the advice first from AI is, that's why it's advice from the deal room, right? Is we're trying to advise our clients and what's the best thing for them, and does it make sense?
Yeah.
What loan type? I want to get this loan type. Well, what are you planning on doing with the property? Oh, I'm planning on selling in 3 years. Well, then this loan
We're
type's
not going to get you anything that has a prepayment penalty or whatever. Like,
that's going to be a painful prepayment penalty. Let's go with one that's got a negotiable prepayment penalty, maybe, that we can say, hey, if we sell this property, we can negotiate. Can't really negotiate with Fannie, Freddie, and HUD on those. So they have their two different prepayment options. So you're not going to be able to go through that process. Can't negotiate them on SBA deals either. However, on conventional financing, we can negotiate and say, hey, if I just did one the other day, like, hey, my client was going to sell this in probably next year or two, like the financing, I don't care if you got to push up the rate a little bit, whatever makes the deal make sense for both parties, gives the flexibility back. So all in all, guys, there's a lot of loan types out there. There's a lot of information in the marketplace. And we will probably dive into different sessions down the road on some of these loan types, more specific podcasts on these, because there are some that deserve a little bit more time. And then we'll break down some deals on some of those and how they actually work in real life, because having that understanding helps you understand, gives you a little bit more knowledge when you're going into a deal. Knowledge is key, right? The more you know, the better you are at your job, the better you are to navigate things going on in the investor world and the business world.
The less surprises that are going to come up down the road if you've been abreast with this information, and you can kind of understand that it's going to depend on what you end up wanting to do.
Yep.
We didn't actually give too many details on bridge and hard, but the hard part about them is they vary so much. So you could have ranges of rates anywhere from like high sevens to 15% or higher. I mean, we don't like to go into the hard money that's north of 15. I think we've only ever really done 12s or 13% most of the time. at the high end. They also have more origination fees. But the biggest reason why that we use them, like we mentioned, the timing is you can have a hard money close in as fast as like 5 business days. So now that's not going to be all hard money or all bridge loans are that fast, but you can have options that are that fast. So if you're in a pickle, they're good options. But like Matt said, we could go into this for hours and upon hours, and we're going to try to cut it short here. We're going to save some more of the conversation for future ones. We hope you guys enjoyed this. We've been enjoying putting these podcasts out. We hope that you guys can continue to like, subscribe, follow, share it with your friends, and let us know, drop in comments if anything you guys would like to hear more about. Maybe there is a part of this discussion that you guys would like us to dive in deeper. Let us know. And we look forward to sharing more with you guys in the future.
See you in the next one, guys.